when you're investing in Nasdaq, you want that growth. And you also, in our models, we want growth at a reasonable price. So we don't have Tesla, trades at 230 times earnings. So we think that curation is going to make a huge difference. It already has. We're outperforming already. And then the second curation is that if you look at the big funds like QQQI and QYLD, they're writing index calls. And I would caution anyone that is a very bad strategy.
All right, welcome back inside our proactive newsroom. And joining me now is Jay Hatfield. He is the CEO of Infrastructure Capital Advisors. And Jay, it's great to see you. How are you?
Thanks, Steve. It's great to be on. Appreciate it.
Yeah, good to have you along. Excited to get some thoughts on what you're seeing around the markets and what's been happening in the financial world in a bit. We'll do that in a second. But first, let's talk about your new ETF. I think it's an exciting one, and QVOL is the name of it. So tell me a bit about it.
Yes, it's really the most exciting launch we have. We have 8 ETFs. And the reason for it is that almost no one appreciates that there's a huge number of what we call dogs of the DAC. So dogs of the Nasdaq.
Yeah.
A little bit like dogs of the Dow. But there are even more dogs because when you buy the Nasdaq as advertised, you're supposedly getting the 100 most innovative companies in the United States, or in the world for that matter. But what you're really getting is the 100 largest companies listed on a Nasdaq. So you get a lot of companies that have slow growth and are, in our models, overvalued. So Walmart, Costco, Comcast, Charter, Kraft Heinz, Mondelez. So you're getting what you really don't want is you're overpaying for companies growing very slowly. And by the way, those are perfectly fine companies. And if you have a dividend fund, like we own some of those, we have a large cap dividend fund, ICAP. That's fine. But when you're investing in Nasdaq, you want that growth. And you also, in our models, we want growth at a reasonable price. So we don't have Tesla, trades at 230 times earnings. So we think that curation is going to make a huge difference. It already has. We're outperforming already. And then the second curation is that if you look at the big funds like QQQI and QYLD, they're writing index calls. And I would caution anyone that is a very bad strategy. You're basically writing naked calls because you don't own the index. You own many of the companies on the index. So instead of doing that, and the index tends to just run as, maybe one day software is doing well, hardware, but it just tends to run up and you just lose money. And if you look at those funds, they chronically underperform the Nasdaq. Our objective with the calls, obviously with the selection, is to produce alpha, in other words, beat the Nasdaq 100, but also with the calls, beat the Nasdaq 100. So curate or choose which companies and only do individual calls are fully valued, where you have a gain, where it might even be out of favor. Like we actually kind of like Broadcom, but everybody's probably going to hate it for a while because they reported kind of inline earnings. So use your judgment. Like don't write calls on Apple right before they announce Siri. It might work, but you don't want these digital outcomes. So we think the combination of those two curations will allow us to beat the Nasdaq and produce 12% income. So we think that's exciting because if you look at the other funds, they've been chronic underperformers of the Nasdaq 100.
Jay, is there a lot of companies to choose from? There's a lot of that fit into the sort of the criteria that you and how do you pick from the list?
Yeah, so we have we do it by PEG ratios, which are shorthand for these discounted cash flows. So we look for, our fund has a PEG ratio about 1. The Nasdaq 100 is about 1.4. So we're getting cheaper companies with better growth. And we have about 55 companies. So we've excluded 45. There's 1 or 2 that are actually great companies that just happen to be listed on New York Stock Exchange. Like Oracle is a good example. It's not on the Nasdaq, but it would, there's no reason for it not to be. We don't include a lot. There's plenty to choose from in Nasdaq 100, but we just don't have all those dogs of the DAC of where you don't really, I don't think anybody who's a tech investor wants to bet on cable beating out Netflix. So That's not a bet people think they're getting. I mean, it gets wiped out because all the other stocks are moving around so much. But in the long run, if you exclude those companies, we think you can outperform a significant amount. And like I said, I mean, no guarantees, and it's just a short period of time. But we've already outperformed. Like Walmart and Costco, which we aren't in, kind of blew up because they're trading at like 4.5 pegs. So any slight disappointment when you're at that big, the market peg's like 1.4. So any small disappointment, not even a disappointment, just reporting inline earnings, you can be way down because everybody's obviously expecting you to blow it out if you're trading at a 4.5 peg. So we think pretty simple stock selection, keeping out of trouble by using peg ratios is a phenomenal long-term strategy. And, de facto, you get more of the best companies because you don't have to be dragged around with the CSX and kind of boring companies.
Yeah. And you bring up an interesting point about all eyes on a company like a Walmart and Costco, like you mentioned. People are watching those all the time. And so would it a case be that some of the companies that you're dealing with can sometimes fly under the radar and have continued success while not as many eyes are on these particular companies?
Well, we do pretty much stick with the larger cap companies. I mean, one
Yeah.
example of that was true when we launched the fund, but is not really true now, is Marvell. That was our biggest overweight, but then it became Jensen Huang's favorite stock. And I don't know why, but for some reason, people listen to him more than they listen to me. And so now that's more of a momentum stock. But we're always looking. We just added some Palantir because it's been hammered down pretty far. We think software companies like Oracle that actually have a cloud business too are overlooked. Hedge funds tend to overreact in the short run, get too excited about these themes. This creates, they actually were hammering down Marvell to like $60 not that long ago because they reported an inline quarter. So there's always some opportunity, not so much like completely missed, because if it's in a Nasdaq 100, it's sort of hard to completely miss it.
Yeah, I understand. Let's talk a little bit about the world that's happening right now in the financial markets. What are you hearing? What are you seeing as far as where things are headed? Inflation. I know it can be hard sometimes to predict things that are happening right now, but it sounds like you're keeping an eye on just about everything that's happening.
Well, we're highly non-consensus, mostly because implicitly most Fed members and most investors are Keynesians. So that means they focus on the labor market. They believe in the expectations theory of inflation, which we think is completely bogus. So they're predicting rate increases. We know Warsh is not a Keynesian, does not believe in the expectations theory. So in other words, that if oil prices are rising, then everybody expects more inflation in there. So therefore you have to raise rates. It's actually the opposite. When there's higher inflation, rates go up and it slows the economy down. So we think he's smart enough to stave off the Keynesians. We're not going to get any rate increases. If you think about it, it's really stupid or incompetent, maybe is a better word, to raise rates when the sole problem is high global oil prices. So what good does it do to tank the US economy because our consumption is relatively small to reduce inflation when the Fed's already tight and almost nobody seems to focus on it, but housing and construction are in recession. So the interest sensitive sectors are in recession. So the Feds are already holding back on the economy. So I think it's hopefully with the three Republican / supply side monetarists, they'll hold back the other Keynesians who are talking about rate increases.
Okay. Jay, as we wrap up here, how do people get more information on QVOL and some of the other things that you're doing at Infrastructure Capital Advisors?
Go to infracapfunds.com, and I would recommend signing up for our monthly webinar and our data and look on our website because we have a bunch more proprietary data that backs up those opinions I was throwing out, about the money supply, about inflation. And I would urge everybody to do that because unless you understand a macro, you're not going to make good micro decisions.
Okay, Jay, thank you so much. Good to catch up with you, and we'll talk again soon, okay?
Thanks, Steve. Great to be on.
All right, Jay Hatfield, CEO of Infrastructure Capital Advisors.